It's more of a normative discussion, yeah. But I'm going to talk across a range of issues, including a number of the issues that we've been talking about extensively during the conference. So let me begin. I'll take for a few minutes at the beginning of my talk to talk a little bit about the regulatory criteria. So the regulator pays a lot. Regulators worry a lot, in part because of the statutory framework. The SEC, in particular, is a very lawyer-driven agency, I think, as most of you are familiar. It pays a lot of attention to cost-benefit analysis. Now, strictly speaking, the SEC has kind of entered into cost-benefit in a somewhat voluntary way, but it is required to some degree to have pseudo-credible cost-benefit analyses to justify its rules. In fact, the absence of a credible cost-benefit analysis was at the heart of the Circuit Court of Appeals decision in 2005 to overturn the Commission's independent mutual fund, independent share and director's rule. I think of cost-benefit analysis as the application of economic principles to particular rules and proposals. And I think it's important to think of cost-benefit, although this is not the way most people at the SEC, I think, view it, but I think it's important to think of it as not narrowly what's easily quantifiable. There is a tendency to think about it narrowly in terms of what's easily quantifiable. In fact, I used to call some of these efforts sort of counting exercises. On a variety of issues, there seem to be kind of attempts to count the number of people who would be subject to particular activities, to particular rules, and then multiply the impact by some arbitrary number. But obviously, that's not what economists, I think of in terms of cost-benefit. I think we think of cost-benefit, of course, as the import of restrictions and how it changes behavior. And I think this is really a central issue. I also think it's important to consider a broad range of alternatives, and sometimes that happens. Obviously, sometimes it doesn't. It seems to me the crucial point is what is known and can be inferred from economic principles. You know, one issue which came up yesterday in some of the discussion was the issue of line drawing exercises. So one of the things that securities regulators often called upon to do is to decide what's the group of parties who are going to be subject to particular rules, and then to draw a line, and then to draw a separate line. And, you know, obviously, discrete boundaries don't necessarily fall out very simply from the point of view of economic principles. But that's often how lawyers think, at least SEC lawyers often think about what cost-benefit analysis is. Obviously, economics is empirically oriented. I think it provides a valuable structure for understanding decisions and behavior. It's helpful, for example, for assessing the impacts of policy. I think it's also very important to understand, as we think about the impact of economics on behavior, obviously there's a whole variety of different margins on which behavior might be operating. On many issues, there's a whole variety of different types of margins. I think one of the central things that economists have the ability to do is to think about and identifying which margins are important for which issues and in which contexts. And I think sometimes there's a tendency to lose sight of that. But I think in terms of understanding the impact of regulation, the presence of multiple margins and how they interact is absolutely a central issue. So one term that I heard a lot, that I don't think I had ever heard before I went to the SEC, but I've heard a lot then and since, is the term unintended consequences. This was a term that particularly bugged me, and it was a term I heard a lot from securities attorneys. Now, in part, securities attorneys use this term unintended consequences to refer to consequences that weren't really their focus or their intent when particular rules were adopted. And they viewed this as, therefore, these had kind of a carve-out, that they didn't have to worry maybe too much about these unintended consequences. They only had to worry about the intended consequences, and in fact, and they were concerned about whether the intended consequences were achieved. They seemed less concerned about the unintended consequences. But I think this is a very important point, because I think what a lot of securities attorneys miss is that those unintended consequences, they're still, as I point out on the slide, they're still real consequences. And they're every bit as important, I would argue, as the unintended consequences are every bit as important as the intended consequences. Indeed, my own sense is that there's probably not enough attention in a lot of ways to unintended consequences. In part because, A, they're real consequences, so obviously important to consider, but also to the I think it's even important to think about the conceptual issue, which I didn't have the vision to think about when I was at the SEC, of how big are the unintended consequences, and what does this say about rulemaking from an ex-ante perspective? After all, the more unintended consequences there are, if we're risk-averse, and risk-averse now with respect to policy, then we should be concerned about the magnitude of unintended consequences from the perspective of do no harm in the regulatory process. And certainly that's not a theme that I think gets attention. So what I'm suggesting with respect to unintended consequences is that perhaps the unintended consequences are even more important than the intended consequences, because this is what regulatory risk is potentially all about. Now, the fact that various economic actors may be close to various margins is, I think, particularly important with respect to understanding behavior. And I'm not suggesting, by the way, that cost-benefit is easy to do or that it's easy to predict the consequences of behavior, but I do think that it's a very, very important issue. It does seem to me that an implication of all that I've just said is an implication, and I've taken the view, and what I've said already is that there's certain margins that are particularly important. Well, it seems to me that all that I've said so far points to one very important margin, which is the composition of the SEC staff. To the extent that these issues are very, very important, it seems to me that economists, like at the Federal Reserve, need to have a very significant role in the agency. And I will say, that the history of the SEC, as I think many of you know, the history of the SEC, I think was not very favorable along these lines. And I for one, just speaking for myself, was very disappointed with the reorganization of the commission last fall, where the chief economist was basically made to report to a law professor who was brought in for that purpose. So I think I think economics is very important. I think the one way in which this theme got a little bit of traction a few years ago, but I'm sure a lot of this is sort of now lost because it's now been quite a number of years back, was as a byproduct of that Circuit Court of Appeals ruling in the mutual fund directors case. Because, and the reason I think that case at the time was important, and perhaps that case will be important in the future, is it does point to the fact that in the underlying statutes, that in fact economic thinking is important to the rulemaking process. So I want to turn to a kind of a related theme, and then I'll start to talk about more specific issues. What do regulators know? What's the nature of their information? Frankly, my view is often they don't know a lot. And why do I say that? Because precisely the difficulty associated with cost-benefit and the difficulty in doing the economic analysis, because there's not kind of these very measurable things, suggests to me that, therefore, the regulators must not know very much. Now, that's not to say they don't know anything, but even the background of many of the staff, relatively few of the staff, as the agency as a whole, are markets-oriented. The background of many are securities attorneys. So, of course, that gives folks at the agency tremendous expertise about transactions, but doesn't about the documents underlying transactions, but not necessarily with respect to some of the broader, important kinds of issues. So as a result, what do regulators do? Well, they do things like they outsource, at least implicitly, some of their needs for information. One of the parties they've outsourced a lot of needs for information to are credit rating agencies. Now, of course, credit rating agencies, they maybe don't know necessarily that much stuff either, as we've kind of observed as a byproduct of the crisis. We've observed these huge distortions of regulatory capital and valuation. And I'll sort of say a little bit more about that. I do think that there's excess reliance by regulators upon what I'll call regulatory sanctioned measurements. And I think sometimes the regulators, in fact, are slow to act. Obviously, in the case of the SEC, there's a number of celebrated examples of this. I'm actually going to pick on one. I'm not going to pick on the Madoff. The Madoff example's obviously gotten lots and lots of attention in the media. But the example I'll pick on predates my time at the commission, and that's the one where they got scooped by Attorney General Spitzer, the case of mutual fund market timing. And this was certainly one where my distinguished predecessor Larry Harris was sort of very, very familiar, and I'm sure he did his best to educate his colleagues. But there what? I'm sure it was. Knowing those colleagues, I'm sure it was. But there were these studies going back to maybe the mid-1990s or so about the ease of timing mutual funds. And these studies are in places like the Journal of Financial and Quantitative Analysis and the Journal of Finance. And they were presented at the leading conferences. But the SEC's mutual fund attorneys really didn't get it until Eliot Spitzer basically embarrassed them. And then they got it right away. And I think overall did then a pretty good job of handling the issue over a number of years, except for one thing. Then even after they extracted massive settlements from the industry, it then took them 4 and 5 years to distribute the money. One of the things I noticed is settlements that were worked out in Larry's period as chief economist and in my first year, which was 2004 to 2005, when I left the agency in 2007, and really even continuing to the present, from time to time, I hear comments that the money still hasn't been, I hear comments from people who were involved that the money still hasn't been paid out. Obviously the folks who were involved on the outside in working through the details would be very anxious to distribute the funds. What do I see as broad themes for effective policy? So here I want to kind of point to just some issues that strike me in terms of my own training as an economist. So the themes I would point to, and then we'll drill down on at least some of these with particular examples. I think it's important to have clear rules of the game, to have pre-commitment, to be clear about what's going to be the import of pending rules. Pending rules, even implicitly pending rules, I don't mean just proposals, can have the effect of freezing the market. This was a point that I raised actually in the context of the paper on securitization. It does seem to me that it's easy to, I think there's lots of reasons why the securitization market is broken right now. I actually personally think that the role of Fannie Mae and Freddie Mac has been very problematic for securitization. But I also think the fact that there are sort of open pending rulemakings that everybody knows, and there's no idea what the import of this is going to be to an issue. Who's going to want to buy into that in advance? In fact, I thought that was probably the most convincing argument that the administration had for wanting to kind of get done financial reform. Although let's put aside the details of the financial reform bill, that it would provide some clarity to the markets, to the structure. I mean, I think ultimately having some clarity, whether good or bad, whether the form of it is sort of good or bad, is helpful. I think predictability, time consistency, these are very important in policy making. I know I myself reacted with some disappointment to the decision by regulators a couple of weeks ago to cancel transactions where I think it was where the price moves were more than 60%, but not cancel the transactions where price moves were 59%. This strikes me as bizarre. And the consequence, think about what the consequences of that for the liquidity process. And I'll try to say a little bit more about that later. Now, in fact, think about also the issue of statutory regulation. Does increasing statutory regulation, does that necessarily increase effective regulation? Well, not necessarily. Because after all, if you increase regulation in some sector or in some way, with respect to some types of transactions, transactions will substitute to less regulated forms. And I think these kind of themes seem to be largely absent from the regulatory agenda. And I also think the import of equilibrium and equilibrium thinking is very, very important in trying to assess policy. I think many policymakers act as if the way transactions are organized and the set of transactions themselves are fixed. They're exogenous. Well, that's not true. It's just the opposite. In fact, the theme of regulatory arbitrage points to that basically the form of transactions is going to adjust. All right. So let me turn now to specific issues. So first, the two specific issues I'll start with will actually overlap a lot with Larry's comments last night, although I'll sort of provide sort of just a slightly different but overlapping and complementary twist. So let me start with short sales, which is sort of one of my favorite issues, I think in part because the pickings with respect to criticizing the Commission are so easy with respect to this issue. And in particular, I think one can be very critical of the Commission across both of the last two quite different regimes in somewhat different ways. So Chris Cox, to his credit, in his wrap-up interview with the Washington Post, said that the single biggest mistake he made, when they asked him what was the single biggest mistake he made as SEC chairman, he said it was listening to the president's working group to ban short sales for those 3 weeks around the TARP. And I thought that was fascinating and really a terrific statement by former Chairman Cox. And it pointed to two things, that the ban was a problem, but also that listening to those guys and the rest of his colleagues at the president's working group who kind of acted like they were the source of all wisdom, that maybe they weren't the source of all wisdom, and maybe they didn't know what they were talking about. Short sales, as Larry talked about last night in a really great way, short sales protect investors against buying overpriced stocks. And the SEC's mission, of course, is investor protection. We want to protect against the pump and dump. Now, I think what happened in Washington a couple of years ago is a lot of CEOs somehow they got the attention of a former CEO who happened to be running the Treasury, and it convinced them that the value of their firms were declining because of short sales. Well, let me suggest some alternative hypotheses. One, there were risk management issues at those Wall Street firms.
Oh, really?
Two, there were problems of evaluation of their asset holdings. Maybe the simplest way I can describe this is the following. If I walk into a supermarket and I'm contemplating buying apples, I might notice that the apples are either more expensive or less expensive than they were the day before. Now, if they're less expensive than the day before, why is that? What?
Someone was short selling.
Exactly. Maybe because someone was short selling. More likely, however, maybe it's because the people who were buying the apples weren't willing to pay as much as they were willing to pay the day before. And let me suggest that ties back to the issues about risk management and asset holdings. So the Commission imposed the short sale ban. So what was the import of that? Well, there were all kinds of operational problems, of course. The SEC staff, to the credit, and the relevant staff was actually headed at the relevant staff in the rulemaking area was actually headed by distinguished economist Eric Siri, who was actually one of the speakers at the conference last year. So it's clear that this ban didn't come from Eric's team. This came from top down. So they had to field the problems that this ban created. And the first problem that arose came right from a few blocks from here. The options market makers basically declared they were going to close. And the options markets were going to close. And why was that? Because they weren't going to be able to hedge. So, of course, the staff, I think, did the right thing under the circumstances. They prevailed upon the Commission to exempt the option market makers. But this points out, and I think the staff did the right thing. Let me be clear about that. But this points out what's so problematic about this sort of thing. Because then basically the option market makers are effectively the only way you can pull off a short position. So you allow the option market makers to then earn rents. Now, this was better than the alternative, but nevertheless, it just illustrates what can be so problematic about awkward regulation. Now, what also happened? You had withdrawal of hedge fund liquidity. Let me talk a little bit about hedge funds. So, I think a lot of this was probably aimed at hedge funds. So, what happened in the hedge fund space? Well, so a lot of hedge funds are short and the long. So, policymakers might have thought, oh, the hedge funds, they're going to become much longer if they can't put on new short positions. Well, no, that's not how a hedge fund does business. If you can't put on as much short positions as you would have liked, if you're running a hedge fund, you're going to adjust downward the long positions you do. You're going to keep presumably you're going to keep your target risk similar. And so this, it doesn't buoy up asset prices, but it does undercut liquidity in our markets. And indeed, then what did investors do? investors saw that the business model of some of those hedge funds were going to be severely impacted, so they put on a new shock of their own. They started pulling out, they started demanding money back. And so, of course, the hedge funds had massive redemptions, and you saw a lot of problems in the marketplace. This basically set off massive withdrawals from the hedge fund, from the hedge funds. And it also pointed out another problem, which I've thought more about in the last 2 days. The devastating impact of unpredictable trading rules. And the Germans obviously didn't learn anything from the events of 2008 because I think they were, they wanted it, they thought this was, they must have thought this regime was so great that they wanted to extend this to CDS and even the trading of government bonds, I think in very odd kind of ways, and in ways that really kind of raise questions as to whether they have any good policy responses in mind for the issues in Greece. The credibility of a market integrity regulator seems to me very, very important. And I think it's kind of even remarkable that in the aftermath of this, at least the SEC pulled back from this after a few weeks. It certainly, I think, a number of the commissioners saw that this policy of this ban was so problematic. But many countries actually retained this for quite a long time. So then we had this debate about upticks. This was one of my favorite subjects. When I was so before I arrived at the commission, under Larry's leadership, the commission put in place a structure for a wonderful natural experiment with respect to upticks, and the SEC had in place restrictions that barred selling short except on a rising tick, and it had those restrictions in place for 70 years. And there was some reticence to just kind of pull back on that directly. So Larry and his group, they persuaded the commission to do then a natural experiment. The commission provided data publicly. There are a variety of interesting papers done with respect to that data. The study that Ingrid Warner and collaborators did is actually in the Journal of Finance. There's a very nice staff study that was done, several other very nice studies. And it's clear that basically that the upticks, that this restriction was just sort of sand in the gears of the trading process. But the relevance of this evidence, which I think is very strong and very powerful, has been, it's been questioned by the current commission without any attempt, as an outsider at least, as far as I can tell, without any attempt to do another experiment or to collect data in a way to kind of really articulate what's really different about the current environment. There were appeals to the issue of confidence of investors, but I think the first order issue with respect to confidence of investors is confidence in process and confidence that regulation is going to be imposed in a sensible way. Now, there were lots of things. I think there are things that there are things that are potentially different about the current era. I think the one thing which is different, which Charles Jones and Eckert Boehmer and a collaborator have highlighted, is that one thing which is different now is that in the natural experiment, you couldn't do a short sale literally on every stock. You could only do it on the stocks that were included in the experiment, but not in the control group. So if you're doing things like index arbitrage, for example, that really didn't quite work. And so potentially there could be differences in the current environment. And it'll be interesting. It'd be interesting if one could drill down on those. One of the things that we did learn, by the way, from these studies was it was striking how much of the trading was due to short sales. I think we found that about 35% in the period we studied, the 2005-6 period, that about 35% of the trades were marked as short sales. Now, this might reflect a number of factors. One factor I think it reflected was just a natural liquidity process. A lot of the trades are coming from intermediaries, and they're accommodating investors. And so sometimes they're net short. They're sometimes net short. The intermediaries are going to be net, you think of a true intermediary is going to be net short half the time. Now, it's also possible that there may have been some mismarking in that. Recently, I had one intermediary tell me, oh yeah, what they did in that period of time was they used to mark everything as a short sale because they said it was infeasible for them to monitor in real time whether they were short or not, and so they simply marked it in this way so that they would then take they would be more restricted in how they could trade. And although they tell me now that this doesn't, their understanding is that they may need to figure out some other way to deal with this because the regulator isn't happy with this, because the regulator is now viewing this as like a false disclosure, even though it's sort of more restrictive. Okay, but I think the whole debate hasn't highlighted the right margins. The upticks, high frequency, this isn't the relevant margin. Even if you think that there's too much short interest, the issue, then you ought to attack short interest. Now, some of the critics say that they don't really care about short interest. It's only the naked short interest. Well, then you ought to attack that. But the upticks are pretty far removed from that. By the way, the whole structure of short sales already places short sellers at a huge disadvantage. Some of us have been aware for a long, long time that if you do a short sale in the market and you're a retail investor, you tend to get hosed. You get hosed because, quite naturally, you're expected to put up more collateral. Furthermore, in many cases, it's hard to get interest payments back from the firm. It's often hard to get interest credit from the firm. So the people who do shorts are disadvantaged. Some of it probably properly, some of it because of maybe some non-competitiveness in the brokerage community. But it seems to me, this is but it seems to me at least that's on the relevant margin. And at the high frequency level seems to me kind of completely the wrong margin. All right, so issue of market structure. So this is a technical area. I think it's important for the SEC to understand, obviously, how the trading works. Obviously, expertise is very important with respect to this. I do think that in some respects, the SEC's reaction has been a little bit political. It's a little hard for outsiders to sort of sort this out completely, and a little hard for me to sort it out completely. It does seem to me some of this is oriented to sort of sound bites and the like. But there's a lot of challenges in really kind of getting and sorting out all the issues. Integrating the order books across diverse platforms. This is a pretty complicated set of issues, no doubt. I was very pleased a number of months ago that the SEC, with respect to market structure issues, issued a concept release with respect to the broad issues, but it was interesting that they issued a concept release, as Larry commented on last night, after making a number of proposals in the regulatory area. The SEC's circuit breaker proposal, well, I'm not a big fan of circuit breakers myself, but I could also imagine, things that would, but I could see, also understand in this context the case for them. But it'd be interesting to focus more upon what compelling cost-benefit evidence do we have from past circuit breakers, and I don't really see a lot of that being cited in the current debate. And so, to the extent that those of you who perhaps have evidence with respect to this, I'd certainly encourage you to kind of contribute to this issue, because it does seem to me that that's not the cost-benefit aspects of a circuit breaker don't seem to me to be the focus right now of sort of discussion. I was surprised that there was a rulemaking proposal being advanced even before even before the reporting is all done. The timing of the proposal seemed to me aggressive, but measured, particularly compared to the Germans and compared to the SEC's short sale ban from a couple of years ago, because I think they're kind of imposing regulations yesterday, so to speak. This seems to me really disruptive to sort of how our markets work. I think it's useful in this context to highlight an issue involving equilibrium and endogenous liquidity. And some of this kind of ties back to kind of some of the issues that Larry was both raising last night, and especially that he raised in his interesting op-ed in the Wall Street Journal last week. To the extent that you have gaps in the book, there are going to be big price moves. So let me pose to you the following hypothetical question. Suppose what you wanted to do was increase the gaps. Not decrease the gaps, but increase the gaps. What would you do? Well, I would suggest that what you would do if you wanted to increase the gaps in the book, you would, among other things, you would encourage platforms to selectively close. That is, you'd have some platforms close and not others. This is exactly how the system seemed to work. Furthermore, what would you do? You would encourage traders to cancel their orders by announcing that your rules are going to be unclear about which executions will be honored. This is, in fact, obviously exactly what the Commission did, at least ex post. So I think this has a lot of implications. It certainly, and Larry's op-ed really highlights, conditional orders are really crucial in this context, that cancellations are important to good order management, that gaps in the book can be opportunities for players, that regulation can actually, instead of being helpful, can actually even amplify the problem, and that clarity about if and when you're going to nullify, if one is going to nullify executions, this seems to me crucial. And it also seems to me crucial that those decisions be made immediately, not 2 days later. Because traders are making other decisions. And I think it's obviously important that we respect the trading process. So I thought I would take up just a few other issues relatively briefly. One issue that I think is very important at a number of different levels is the nature of responsibility of investment advisors. And I think an issue where there's not a lot of clarity. And in part, there's not a lot of clarity because if you think about the brokers versus investment advisors, on the one hand, the statutory framework is completely different. The investment advisors have important fiduciary duty. A broker, of course, has no duty, or almost, not no duty, that's too strong, but the broker doesn't have much duty. And I think it's a huge economic issue. And I think it really cuts to the nature of the underlying principal-agent relationship. What are the regulatory standards? There's clearly lots of confusion by retail brokers. By retail customers. If you ask a random retail customer about his broker, he thinks his broker is supposed to act in his best interest, right? This is, if you did a sample, 80% of America's brokerage customers would think that, I'm sure. And clearly there's lots of confusion about this issue. I think it raises questions about, the viability of having these multiple regimes. But at the same time, in an institutional context, it seems to me the issues are quite different. And I was fascinated by some of the discussion a number of weeks ago at when the Goldman Sachs team was testifying before the Senate committee, and the senators kept pushing back on Goldman on this issue. They said, well, how could you sell products to institutional customers that you didn't think were great products? Didn't you? How could you do this? And I think that reflected I thought in that context, I thought it reflected some confusion. But it kind of, I think implicit in these comments is it suggests that kind of context is important and kind of probably greater clarity. This is probably an issue for greater clarity. So money market funds. I think this is an issue. This issue also came up in some of our discussions here at the conference. I think there's an issue where there could be great improvement. In particular, and the issue here is the pricing exception to the basic NAV, and breaking the buck if you get a valuation change of more than 1/200th. Now, obviously, after Lehman Brothers collapsed, there was a run on reserve fund, and then insurance the federal government offered insurance for basically all the other funds. This in turn, by the way, has created massive expectations about a future safety net. Now you might say, well, the reserve fund, there's customers lost. That's true. But as long as you're not in the fund that's first in line, you probably now have some expectation that you're going to get paid off down the road. Now, in this particular case, for a lot of problems like this, there may not be obvious solutions. In this particular case, I think there is one. NAV is a perfectly good solution. The problem with our current system is that once you get some departure, there's a huge incentive to run. But if you allow prices to adjust, it eliminates the problem. The institution can be redesigned to simply eliminate the problem. And if one is going to provide insurance, it could be priced in a way that would be sensible. But I'm not even sure that the issue is about insurance. It seems to me that just focusing on NAV would be a way to go. I mean, another possibility is to disclose virtual pricing and leave the current regime, but it's not clear which way that's going to work, because it may be that disclosing the virtual pricing would just provide signals to everybody about how to run. Let's see. All right, I think I'm going to be kind of quite selective so that I can kind of wrap up soon. So I had some remarks here about market integrity versus financial stability, but I think I'll leave that for some other time. The point basically, though, is that the Fed and the SEC generically have very different types of views. The Fed is focused upon financial stability and prudential supervision. The SEC has traditionally been focused more on disclosure. These two objectives potentially clash. When we think about what more regulation means, and I think either they did crash or they should have clashed in the context of a whole range of different situations, ranging from how stress tests were handled to the Bank of America acquisition of Merrill Lynch, and the Fed's lack of interest in transparency there, to AIG transactions, to short sales, to fair value accounting. I mean, it ranges across. It seems to me that transparency is, in fact, the friend of the financial stability regulator. If we look back at 2007, the problem was there wasn't enough transparency in the markets, and we didn't know who was holding the losses. And it seems to me that here there's probably more scope and opportunity. So I think the issue of corporate sanctions, this is one that's a little bit below the radar screen. It was one that got a lot of attention during the period of time when I was at the SEC, in part because several of the commissioners were not very excited about the notion of corporate sanctions. And in particular, and I think this issue, it came up at least indirectly in the Bank of America case, and it comes up implicitly in a hypothetical. Imagine that the SEC enforcement attorneys, imagine they found some maybe not so appropriate behavior at, let's say, Fannie Mae, at Freddie Mac, or Citi. What should the SEC enforcement division do? Should the SEC enforcement division go charge ahead and bring actions against them? Well, maybe they should. I don't know. I think they should bring actions against the individuals personally, but do they want to? And I think it depends also on who's the victims. But in particular, suppose stockholders are victims. Does one want to then impose? Does one want to impose on the victims more sanctions? Not clear to me. If you were stockholders in a company and there was accounting fraud and you were a victim of the accounting fraud, what's the point in then imposing a fine on you? Well, the SEC, the securities lawyers would say, oh, well, we'll impose the fine on you, but then we'll rebate it back to the stockholders who were the victims through a fair fund. Well, of course, the fair fund process is costly. That's one aspect of it. Arguably, once this fraud became public, the marketplace would have put into the pricing some expectation about the value of the sanction. So what's sort of the point of this sort of circle? And I think my instincts about this are really reinforced by thinking about the hypothetical with the government's a stockholder. What sense would it make to pay a bunch of securities attorneys working for the Division of Enforcement so that they can bring an action against Fannie Mae or Freddie Mac where the government basically owns all the stock? I mean, I think this really kind of brings out the point about corporate sanctions.
Now, the answer is it reduces the amount of money that the class actions attorneys.
Well, yeah, fair enough. I heard a lot about that when I was at the commission. But now the SEC has, to its credit, so far retained, and I must say I wasn't a huge fan of this policy, but the SEC has retained. I wasn't a huge fan of some of the details, but the SEC has retained the 2006 policy, which in a form tries to address the issue of corporate sanctions. So far, at least, they haven't pulled back on that. But it's been interesting that some of the controversy that arose in the last year or so about the settlement process at the SEC and whether these enforcement attorneys needed to come to the commission with respect to settlement negotiations. All of that controversy and how the new chair was going to kind of pull back on that, all of that controversy was actually in the context of corporate sanctions. And so arguably, and I don't know what was in the thinking certainly at the commission about this even when I was there on this point, but arguably the reason that the commissioners imposed restrictions on the enforcement attorneys in terms of the settlement negotiations was that perhaps some of to the extent that we know that some commissioners were uptight about the issue of corporate sanctions, it may be because they only imposed restrictions in the cases of corporate sanctions, and it may be that there was sort of some important connection. I do think, and of course, in this getting tough era, obviously much of this nuance has been lost. I think individual sanctions are potentially very, very important. And obviously the problem here is that there's so much incentive for the individuals to fight. There's incentives to fight because their human capital is at risk. There's incentive to fight even because of indemnification by the companies, so in fact the out-of-pocket costs aren't theirs. Well, I've already talked a lot. I got a few more slides, but I think let me just open it up to questions. I'd certainly be interested in hearing your feedback. I've certainly probably said a little bit too much today, but anyway, I'd be interested in your thoughts and your questions. Paul.
I think I remember Eric Suri saying, maybe this is my own quotes, but something with regard to the short sale ban. We all knew it was a bad idea, but we had to do it anyway for political reasons. So I guess does the SEC really even want to get it right economically a lot of the time, or is there a lot of pressure?
Well, I was not a commissioner, so it's sort of hard for me to. It's hard for me to have sort of, and I think different commissioners have had different views, and obviously also different folks have different views about what getting it right means. I think this issue, this short sale issue, was arguably a little bit of a tail issue. My sense was that the political pressures on this were especially intense. And you see this in a number of forms. You see this in the aggressiveness with which the President's working group did their thing with respect to this issue in September '08. You see this in the lobbying from Capitol Hill during the vetting process for the new chair of the commission. So, arguably, this is an issue that probably has had more political attention than most. But is the commission that interested more broadly in getting it right? Well, I think that's probably a question that's maybe best asked to commissioners. But I think the right tack for economists to take is to sort of try to provide more perspective on what getting it right means, and implicitly, therefore, on what is not getting it right. And that's part of the reason I raised the issue of corporate sanctions, because there I think economic principles are actually pretty clear, and the perspective, and that would be an issue where historically there have been somewhat diverse perspectives at the agency.
Chester, I wanted to ask a favor of you. So, speaking as a current employee of the SEC, the last 2 days we've taken some knocks, I think. And to the Commission's benefit, they were able to retain you for 3 years. Yeah. And so we are trying to grow the number of economists by about 30% over the next year. So can you speak to some of the benefits or the, the intellectually stimulating environment, whatever it was that you
fair. That's it. Okay. Okay. So Jennifer, that's a terrific question. I valued a lot my SEC. Okay, so let me say a number of things. So I valued a lot my SEC experience. I felt I learned a lot about lots of different issues. And I think that's sort of reflected today in some of the range of issues that I talked about, and also even the couple of issues that I didn't talk about at the end of my slides. It provided, I think, a very useful and informed way to frame issue. I actually valued a lot my interaction with those securities attorneys who I've criticized a lot today, because I learned a lot about their perspectives, and sometimes obviously they brought knowledge. They certainly brought knowledge to bear on different kinds of issues. So, I also think that the environment is arguably even a much more interesting environment now than it was in the sort of like in the middle period that I was there, kind of post Sarbanes-Oxley, but before the market crisis. Arguably, this is even a kind of a more interesting environment. So that would be kind of my recruiting. That would, I guess, be my recruiting ad. The concern, the issue in my mind is sort of an outsider is sort of, just about the openness to economics and, and how things, there's not been a lot of clarity to the outside with respect to the reorganization. Some of us on the outside observe things like the new division being populated by securities attorneys from Wall Street, and wonder, are those then going to be intermediaries that are going to kind of further isolate, so I think there's sort of issues about that. I thought. So I thought there was, in the period I was there were a range of interesting kinds of analyses that were being undertaken. David Cicero's terrific paper, for example, that was in the JF last year and was actually written up in the Wall Street Journal in December 2006 on the backdating of option exercises. David Cicero, who was at the time a graduate student and our staff member, did this terrific. David was the first one to identify in a systematic way the backdating of option exercises. So not only were the grants backdated, as Eric Lee first very cleverly identified it, but in part because of tax fraud types of strategies, the exercises were being backdated by CEOs as well, not just in isolated cases. David, I think, must have seen this in some isolated cases, and then he looked systematically at the data. We had very interesting studies in the period I was there, about dividend capture. Stuart Mayhew and Avner Calais and one of Avner's students have a very nice paper in the RFS about this. The work that I was involved in with Cindy Alexander and Mark Chen and Dwayne Seppi, who were then visiting the commission on proxy voting advisors, is coming out in the Review of Financial Studies. So there were opportunities to drill down on a range of interesting issues. The staff work, I think, on the short sale issue was terrific. There was a very nice paper by Kathleen Hanley and Amy Edwards on short sales in the IPO process. That's coming out in one of the top outlets. My colleagues continued the wonderful work that they did with Larry on bond market transparency. So there were a range of, I think, interesting and important empirical issues. I think one of the challenges now is that hopefully, I hope that the leadership within the division and the commission is respectful enough of the importance of economic analysis, and in particular the importance of sophisticated thinking at the level of top-tier journal publication, and viewing that within the mission of the agency. There haven't been uniformly consistent signals about that, at least in terms of some of my own personal interactions. So I want to be kind of clear in terms of, that I don't want to be just kind of a recruiting agent for the agency without viewing also what I view as some of the challenges, which I think are partially self-inflicted on the table. But I think those are things where, if the agency has the right philosophy, it's really a great place for talent. Okay, fair enough.
I'm a horrible lawyer. And so my question to you, and I don't know the answer, but it intrigues me, and I'm thinking about it, and after we're done here, I'm going to go join the business ethicists in their conference. You were talking about the issue of corporate sanctions instead of going after the individuals who are fraudulent. And that's to a certain extent because that area of the law is losing a sense of the mens rea of the individuals, because usually when you have a crime, you've got to have the act and then you have to have the mens rea, right? But it seems like a lot of time the discussions about financial markets are they're amoral markets. So are we sort of necessitating a getting rid of a mens rea if we're going to have amoral markets and not worry about ethics? And if we're going to collapse ethics into what is legal, which many, many people do, right? Then cycling back to the beginning of your presentation, if we have to have a law that says this, and then it has the unintended consequences, because you can never fully legislate everything that should or shouldn't be done. So if we want amoral markets, do we have a choice other than to have all these legal rules that then create dysfunctional problems? I don't know. I'm thinking about this.
Yeah, I don't. So your question is obviously a very sophisticated one, and I think it kind of goes off in a direction that probably goes well beyond the depth of my expertise with respect to the law. So let me sort of say that at the onset. So one facet. So what I had intended. So I recognize the difficulty of bringing individual cases. I obviously pointed to some different factors, I think, than the ones you were highlighting, but I recognize that difficulty. but I do think that's incredibly important. And part of the reason I think it's so important is I think there's a kind of a falseness. My point about corporate sanctions is that in some matters there's a falseness to corporate sanctions. Now, in some matters, I think corporate sanctions would be fine. You know, obviously, if the relevant environmental agencies bring corporate sanctions against British Petroleum for what we're observing in the Gulf, you know, obviously fine. You know, if Goldman Sachs loses their civil fraud, you know, and I don't have a view about the boundary of civil fraud and where the Goldman Sachs transaction is, but in the Goldman Sachs matter, it's clear that the victim, if it's an illegal matter, the victims aren't the Goldman stockholders. So I don't have any problem there with corporate sanctions. Where I think the problem with corporate sanctions is, it's when the stockholders themselves were the victims. And then, you know, what does it mean for an enforcement attorney to win a case or bring a case when it's the stockholders themselves who are the victims? And I don't think thinking deeply about the economics of that has been done sufficiently. And I do think that the current context where, you know, we have the Bank of America case is an example, which is arguably in this vein. You know, one could take the case, if you're a Bank of America stockholder, you could say, you know, this is outrageous. You know, you could say with respect to the settlement, this is outrageous. Here, the Secretary of the Treasury and the Fed, they were playing all kinds of games, and now we got to pay, and we were the victims, and now we got to pay the sanctions again. But I also point to the hypothetical: Fannie Mae, Freddie Mac, Citi. You know, it's obviously easy to imagine that there'll be some violations there. But, you know, what should securities attorneys do? Should they spend resources even going after this? I think that raises. But I think the stockholdings of those companies, I think, point to the issue of corporate sanctions in a kind of a little bit of an idiosyncratic way. But I think provide a little bit of a broader lens into the issue of corporate sanctions. Go ahead.
So I took your question to be, what's the role of rules in relation to ethics? And it introduces two themes that come up in regulation. One theme is the question of rules versus principles. So the principle is you should all behave ethically. And so if we just give rules, then people, if they conform to the rules, is that okay? And then, of course, the problem is that maybe the rules aren't comprehensive enough. So most of us favor principles, but in practice, the problem with principles is that there's an awful lot of uncertainty associated with principles. And what happens is that then they become very expensive to, it becomes very expensive to comply. What happens is then you hire attorneys to write out justifications for your behavior subject to the principles, so that if you're ever called on the carpet, is that you've documented that you actually paid attention to the principles. Although clearly this can be very attractive, it becomes a catch-all. The other theme that concerns in this direction addressed or head towards is the question of enforcement versus supervisorial philosophies towards regulation. So the SEC very clearly has an enforcement orientation. We figure out what the rules ought to be, we write the rules, and then we enforce them. And of course the problem with this is it often takes them too long to figure out what the rules ought to be. And then once they've established the rules, as you mentioned, there's always ways to substitute around them, and that may violate the principle of the rule, but since we're only enforcing on it. And then you finally have the problem of if it's very costly to do the enforcement because the surveillance doesn't discover the problem, or because the enforcement action itself is very expensive, or if the sanctions are not sufficiently large to cover the fact that the probability of enforcement is not very large, then the deterrent effect of the whole system breaks down. The alternative, of course, is a supervisorial system where the supervisors have general responsibility to look after what you're doing, and they have enough power to basically say, listen, what you're doing doesn't look very good to us, and if you don't stop doing it, then you'll problem there is